I do want to shift to the market side of things. What do you expect the markets to do from here? We talked at the very beginning of the interview about how you think I can't remember the word you picked. Was it absurd or something like that in terms of the disconnect between current prices and the macro data? But what kind of year are you expecting in the markets?
There's a lot of people that have these year-end price targets, and all the strategists on the street have price targets. The main strategists were like 3,800 to 4,200, so they were in this tight range. I really don't care what the end of the year looks like, because it could be a messy type of year where you have these upswings and downswings, feast or famine. And I think that earnings are going to be really important for Q1. We run up into earnings. If this market just continues to run up into the March meeting, that maybe the Fed will do 50 basis points. I think I read today that the hikes in May are pretty much going to happen. The market's running higher when Powell is trying to tell people that we're going to continue to raise rates until inflation is at 2%. It just makes no sense to me that people are fighting the Fed aggressively by buying stocks, which I get. Sometimes you just have to hold your nose and buy. But the risk is that those earnings come down. We create another bubble. I mean, the Fed is great at fixing the problems that they created by fixing other problems that they created. And we're in this endless loop of that, where they're fighting inflation. That's their job, their mandate. But they basically, with their stimulus of $4 trillion and all the other stuff that they did, lowering rates, they created another bubble. And now they're fixing inflation and they're diligent about it. If the Fed just stopped raising rates and said nothing, I mean, they talk too much as well. They're constantly talking. If they just stopped raising rates and the market was just left there saying, okay, well, what are we going to do? Then I think the markets would probably price themselves into a more rational market. But it's always the hope that the Fed's going to be there. And look, we're conditioned to it as people that have been in the markets for 30 years. We're conditioned to watching what the Fed does or what they might do next. But basically, our people are thinking that he remains the same, as dovish. And maybe he knows some news that we don't know. I think the Fed just makes it up as they go. They'd rather have the markets going up because there's less political flack on them. And they don't want to cause a depression. Inflation's going to stay higher. Consumers' bank balance sheets are going to decline. And then what's going to happen? It becomes more of a crash scenario for a lot of people. And trust me, anybody that loses their job and then they can't find new jobs, that for them is a hard landing.
That's a hard landing right there. Exactly. Yeah. I talk about that a lot. At the end of the day, it doesn't matter what the economists are dickering about the official definition of a recession. It's there when you are afraid of losing your job or you lose your job, right?
And I've been through cycles. I've had firms go up and I've had firms go down, and I've had, back in 2001 at the tech bubble burst, the firm I worked for laid off 3/4 of the firm. And certainly not easy to handle. And when you have high inflation, it makes it even harder to feed your family and find a new job. I think companies are hoarding workers right now. And until they need to start to lay off people, and we're not talking, Meta, they had a bloated amount of employees. The people that you go to stores, your local restaurant, you start to see fewer people there. That's when things really start to they hit home.
Yeah. And, I track layoffs pretty closely. And initially people were trying to be dismissive of, it's just big tech. It's those bloated Silicon Valley companies, right? But the contagion is really spreading into a number of different other non-tech verticals, categories, sectors now. Like you said, that's the game changer, is when people are, obviously it's a game changer when they lose their income because they can't buy stuff, right? But also it's when they're afraid of losing their income is when people start tightening their purse strings. And because the economy is so driven, consumer spending driven, that fear has a big impact in and of itself, that negative wealth effect.
So then we go back to the whole demand issue.
Right.
This is going to be a clean quarter. You have basically it's a perfect scenario. You have the markets are going up. You have unemployment at record lows. You have liquidity in the system. But is the consumer going to slow down and not buy an iPhone, not buy a Tesla. For example, Amazon Web Services. They're a brilliant company. It's the core of Amazon, and it's where they make their money. A year ago, they were growing at 40%. They just reported a big downtick this quarter and projected next quarter, this quarter we're in now, will grow at only 20%. So that's a big deceleration. What happens after the quarter after this? Are they going to say they're going to grow in the mid-teens? And maybe mid-teens is still great for companies, but those companies they have so many different clients and so many different websites that they handle. And it's a great indicator, by the way, that if those companies are pulling back on AWS services, then I think that that's a big problem that's across the board on websites out there. I mean, I have a website, I use Amazon Web Services, but if people start to pull back there, that could be a big tell for the economy. So that's one that I'm really watching.
That's an interesting indicator. Okay, that's great. Well, okay, so you don't get to go to war with the markets you wish you had. You go to the war with the markets that you have, right? So how are you approaching allocating in this environment? Like, what's your approach?
One of the things that I show on, hedge fund telemetry, I have a model portfolio. Every trade that I do reported on one of 3 notes that goes out every day, and they're all tracked. The winners and the losers and even the stinkers are in there. I have I have parameters that I try to stress to people what to do. I don't go over 5% on any initial allocation. I try to keep my sizing restrained. I think one of the best ways to lose money is to have too large of a position in something that's not working. The other thing is I like to keep my anxiety levels down. So if I have a 5% position in something or a 2% position in something and it's going against me, it's not going to necessarily kill me. It's not going to change my day, week, month, or year. So that's what I'm doing. I'm trying to stay very diversified, and I'm currently net short 30%. And I have a fair amount of cash on top of that. 30% net short of what I currently have. I have a couple value ideas in there that are as longs. I like Paramount, the cheapest of any media company. They do have some growth issues. They're spending a lot of money on their content. I think there's a lot of low-hanging fruit that they can harvest there. I like Verizon, as much as it may be the most boring stock, but if you get a return of 5-6% and they have a 5% or 4.5% return on their yield, that's not so bad. So I like that. People tend to pay their phone bills first,
right?
And because they've got to stay connected to Twitter and TikTok, and
they got to watch their welfare videos. I mean, come on.
That as well. But then again, we're seeing one other thing that's a little concerning is that we're seeing repossession rates go up on cars. So we're starting to see that in the consumer place. That starts to hit, and then that moves into housing down the road. So I have some housing shorts that I mentioned. I'm short Tesla, their little car company. I did take a lot off lower. My average is 100 points higher than where it is now. I took the majority of it off lower. I know the stock pretty well. It does crazy, stupid things and goes up. And I avoided a lot of the upside in my face action, and I probably will add to it, because that's one of the companies that I think will have a demand problem, even as they have lowered prices, which includes a margin problem. So I have that. And
I'm just curious, because we're going to get comments from the Tesla folks.
Oh, hi, Tesla folks. It's not personal.
Yep.
It's technical.
Yeah, problem is with Tesla folks, it's always personal. But just real quick, since you mentioned it, in a nutshell, why do you expect a demand problem there? Or do you mean demand, like we were talking earlier, just a consumer affordability, they could be able to afford less?
Look, it goes into the higher rates, makes it harder to buy cars. They have a very tired fleet of cars that they haven't made any changes to for a while. China's reopened, and the China data from December to January was better, but if you look at from November to January, the data is actually down. That's with huge price cuts, and it's that in itself. They have 2 new factories that are coming online, so they're not going to have a supply issue. Their supply chains are reopened. So there's going to be a lot of cars to buy, and they're not necessarily cheap. A lot of them are going to, some of them are going to get the benefit of the tax credit that's out there, but you've got to jump through a bunch of hoops and make less than $150,000 to buy a $50,000 car. It's a stretch. I could be wrong. Stock is one that just has a crazy mentality to it.
Yeah, that's fine.
On the
I didn't
long
want to rattle
side,
on
wait, hold
Tesla
on.
because you could talk about it forever.
I don't want to. It's sort of the bane of my existence. I'm short Coinbase. I'm just looking at my portfolio here. I'm short Coinbase, and I just added it back a few days back. And I think their earnings are going to be weak next, or when they come out. I think they're out next week. And just because the entire quarter that they just had, crypto went nowhere. And we just had like a nice bounce. I don't know if that's necessarily reinvigorated the crypto people, but I think it comes down to transactions. And this was when I was short a while ago, and I covered this one in a lot lower, 50% lower recently, and it's just spiked up. So I'll take advantage of the timing on these and cover low and sell short high. On the long side, I like Disney. They report this week. I think that the company could surprise, and I like that there's an activist investor involved, that Disney's resisting. And if you go back to the Procter and Gamble scenario with Nelson Peltz, he tried to become he was an activist in Procter and Gamble. They resisted, and he got on the board. They instituted his changes, and the stock went crazy on the upside. And ultimately, when Nelson Peltz resigned from the board, the CEO said he was absolutely fantastic. And I know some people that are good friends with him. He's a tough cookie, but he's very, very good. He's a very good operator. So I think Disney has a lot of, I like media companies, as you can kind of tell.
I can tell, yeah.
I was a media trader at one point in my career. So I like Disney on the long side. I'm long Ford, and that's been actually, I bought that lower, and that's actually been a sort of a pair trade with Tesla. So I'm up 16% in that, and offset some of the small amount of Tesla that I have short. It's done okay. I was long Lucid, by the way, at the lows, and I made like 20% on it. And this was right before the stock went, crazy on some rumor. And I got out of it. I was like, oh, that would have been nice. But sometimes I will see some of the indicators that I use and hold my nose and pair off something against another idea. And so that offsets some of the Tesla lift as well. I'm short gold, which is probably not very popular with people, but I think the dollar could go up from here.
Is that why you're shorting gold, as a response trade to a stronger dollar?
Yeah, I think the dollar could go up from here. I have a lot of indicators that are telling me that, and I'm short home builders.
Hey, do you mind, only because you mentioned them earlier, do you mind sharing those two ETFs, the home builder ETFs that you're short?
Yeah, ITB and XHB. And they're mostly the same, but one of them, I forget which one, has Home Depot and Lowe's and Williams Sonoma and other suppliers, Sherwin-Williams and Masco and Mohawk. And those companies have also seen contraction in their business as well. So if people are buying less paint, I think Home Depot is probably a good one to watch, because generally the spring season, there's a lot of new houses sold. And when you buy a new house, you go to Home Depot and you fill up your basket twice with everything you need, from mops to brooms to light bulbs to batteries and all the other stuff that you need for a new home. So if the housing market doesn't really turn over, I think that'll be a risk in the spring. So I'm not short Home Depot, but I'm just doing it with the ETFs. I don't really have major conviction overall in the market right now. There's times where I get really, really bulled up, and that's when people are like, Tom, are you feeling okay? Because it looks like it's coming to the end of the world. And then there's times where I get really bared up, and I'm sort of neutral, leaning more bearish right now.